Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, good evening. Today is Monday, March 16th. I'm Huang Peng Ri. You should be able to hear me and see my screen. This week there are many important events and some changes, so it's likely going to be a pretty busy week. Besides that, we'll keep an eye on geopolitics and any potential opportunities it might bring. Let's go through them one by one. First, since it's before Monday's market open, I'll remind you what to watch for as the market opens this week, and which individual stocks might have opportunities to perform. Then, we'll look at the current stage of geopolitical developments and where things might be headed next. There's also a lot of economic data this week, but since most of it is from January and February, its current importance is relatively low. Today, we'll see the February industrial production and capacity utilization rates. Right now, it's just past 9 o'clock. Expectations are for a slight decrease, but it's still positive. Capacity utilization is also staying at a relatively high level, so for now, it seems that over in the US, their overall industry is still seeing steady growth, though the pace of that growth might be slowing down a bit. But overall, it's still a growth process. Honestly, if it weren't for this Iran conflict, both the economy and the stock market would likely be performing quite well right now. This week features several key events, most notably GTC and OFC. Both are happening this week and are major highlights. GTC runs from the 16th to the 19th in Northern California, while OFC is in Southern California. Actually, there's a very important event early this morning. Well, early on March 17th. Jensen Huang will be giving a keynote from 2 to 4 a.m. today, covering a wide range of topics. Many individual stocks might see some heavy volatility during the speech, so we'll have to see how that plays out. If you don't want to watch the speech in real time, you could set some limit orders or just take a quick look before the market opens to see which of your stocks might be affected and plan your trading strategy. Then, on the 17th, tomorrow morning, there'll be a technical deep dive. Also on the 17th, the OFCCO forum kicks off, covering broader industry trends, also tomorrow morning. And then, early on the 18th, there's quite a lot going on. At 1 a.m., OFC officially opens, and from 3 to 6 a.m., there's the Data Center Summit. They'll likely discuss interconnects, data center processing, current challenges, and future outlooks. But on that same day, well, early on March 19th, we also have the FOMC meeting and press conference. So we'll see how these industry events and the Fed's actions impact market sentiment. So right now, everyone is really hoping that GTC and OFC can give AI stocks a much needed boost in terms of their future outlook and how people currently view them. Because, as you know, the overall market sentiment isn't great right now. We really need a catalyst to give stock prices some upward momentum. So that's one part of it. The other part is the FOMC meeting. Currently, the expectation is that the FOMC won't cut interest rates. Since this meeting will include the dot plot, it will reveal the future direction of interest rates, the economic outlook, and views on inflation and employment. So this FOMC meeting is actually quite important. Will the market sentiment be affected after these announcements? There's a lot of uncertainty, making this week's trading quite challenging. On one hand, there might be some, well, not exactly swing trades, but short-term opportunities for oversold tech stocks to bounce back, or for certain tech sectors to continue their upward trend. On the other hand, regarding the FOMC, while no rate cut is expected, there's still a lot of uncertainty about the future outlook. This part is actually gonna be more divisive. So at this point, we can first get a general understanding of these events and their potential future directions. Alright, next, let's take a closer look at GTC. Since it's about to start, what are the key things to watch for? Well, this time, we really need to look at the specification details of the Vera and Rubin architecture platforms. How are they going to integrate the CPU and GPU in the most optimized way? Back in January, there was an article that briefly mentioned the specs and how they do it, but it didn't go into much detail. So everyone is really looking forward to hearing more specifics. Also, the most important thing is the shipping readiness. We all know that Blackwell had some delays previously, so we need to see if Vera Rubin will also be delayed. If not, it's expected to launch in the second half of 2026, which is coming up soon, and partners will start selling it. That's what it says on NVIDIA's website. Generally, though, it's more likely in the second half of 2026. Or, even more likely, shipping will truly start ramp up in the fourth quarter of 2026. We also need to watch NVIDIA's future product roadmap. After Vera Rubin, their current pace is to have an update every year. So, what will the next updates be? Do they have more plans in place? What will their roadmap and development look like after 2027 or 2028? Additionally, there's the progress of AI agents and physical AI. Regarding AI agents, there are currently many different types of agents, like the recent Devon. Actually, AI agents are significantly disrupting software stocks right now, so we should also see what their current views are on this AI agent sector. Are major software stocks really out of the race in this AI agent competition, or do they actually have some leverage points? This will actually affect the overall performance of the software sector, as well as foreign investors' views on their valuations. On the other hand, regarding physical AI, he has mentioned it several times in the past, like self-driving cars, robots, and so on. What is their progress? Because, well, in the past, it was all at a very early stage. It was just about announcing who I'm partnering with, what chips are being developed, and so on. But now, people want to see more. More real-world implementations or more proof of large-scale applications. Like that. And going forward, we need to observe NVIDIA itself. The company has actually shifted toward becoming a system-level solution provider, because right now, we can see that NVIDIA is constantly updating and developing in the AI space, finding its own positioning. It seems that besides being a company with its own ecosystem, it's also bringing many things back to do in-house. And going forward, because the complexity has increased, doing many things in-house now can ensure stability, control costs, and allow for faster delivery. So why not? Therefore, this will also affect the entire AI hardware supply chain. Layout, some manufacturers might benefit while others might not have as much of an advantage, and so on. This is a current change. And this is also a direction for a future observation. Now, Jensen Huang previously mentioned this 5-layer AI cake argument. Actually, his conference this time should provide a significant boost to both hardware and software, because right now, the AI system needs to go through many different levels to be designed together. It needs to be designed very well to improve computing efficiency and scale. This actually includes energy, chips, infrastructure, and finally, modeled in applications. So at this GTC, it's not just hardware stocks that should get a boost. Hardware stocks will very likely be boosted, but for software stocks, there's actually a turning point. In this context, we can look for opportunities in the software stocks everyone holds. If you don't have software stocks now but want to invest in software, you can look into this area. See which companies are better or undervalued. Okay, next let's look at OFC. The highlight of OFC is that it's a more academic or engineering focused conference, unlike GTC, which might have a relatively lower barrier to entry. So right now, we're looking at how OFC aims to solve the computing power bottleneck at this conference. Because we all know that as AI has developed to this point, chips are very important and storage is very important. But going forward, interconnectivity is also crucial because a data center is only so big on its own. If it can work with other data centers, or even if data centers over longer distances can be linked together to provide computing services, it'll create a 1 plus 1 is greater than 2 effect. This kind of scale where many data centers gather to provide more large-scale services. So this is interconnect, which is a major point to watch moving forward. Now, we all know the saying optical in, copper out, but is that really the case right now? Is fiber taking over everything, and is copper truly gone? Well, not quite yet, because copper still has many uses, and it's cheap, reliable, and very stable. So for now, copper is still very commonly deployed in data centers and server racks, but that's just for now. In the future, it'll gradually shift toward optics over time, because as transmission speeds increase, copper just can't handle the load. That's why, even though many copper-related stocks like CRDO and others have decent revenue performance, their stock prices struggle to climb higher. The reason is that stock prices reflect future expectations, and if you're likely to be replaced in the future, it's hard to see sustained growth, though there might be some swing trading opportunities. Also, we need to watch the progress of co-packaged optics, or CPO. If it's successfully developed, it'll be impressive, but its cost is high, and there are many issues to resolve. There's no good solution yet. If a component fails, you might have to replace the whole unit, or even the entire server, so people are still hesitant to adopt it. So right now, actually, there are alternatives like linear pluggable optics or LPO, but LPO has its own issues. Currently, most people are using LRO, which is a more balanced compromise for now. As for CPO, there is some progress. CPO needs to advance for 1.6T and 3.2 transmission to be possible. We'll compare LPO and LRO later. Next, we can also look at the deployment of optical circuit switching, or OCS. In current data center horizontal interconnects, only Google is using optical switching. Optical switching offers many benefits, like low latency and low power consumption. We'll see if other data centers adopt it, or if full optical switching is still a long way from becoming a reality. That's another key point to watch. Now, let's look at how optical in, copper out is developing. Transmission efficiency will keep increasing. It's an inevitable trend as the demand for computing power and performance grows. In this context, signal loss in copper wires becomes more severe and their effective range gets shorter. Their effectiveness weakens. They might work at this distance but not any further. As computing power increases, that effective distance will keep shrinking. That's why fiber will eventually replace copper. However, at this point in time, large-scale copper deployment is still the reality. Currently, within different length ranges, there are two types of copper cables. The shorter ones are active copper cables, which use direct analog amplification. It doesn't have any of this digital tuning or reshaping, and the reason for that is, why does it just do analog amplification? Because it's really short and it doesn't really need to reshape the signal. It can just amplify it directly and give you the signal. The benefit is that it has very low latency and very low cost, so it can be deployed more quickly. I've listed the manufacturers here. Now, if it needs to be a bit longer, then you'll need a retimer or a DSP chip for retiming. That would be a bit more standard, like 5 to 7 meters. For now, you can still use AEC. The cost and latency are a bit higher. Credo is currently the main manufacturer in the space, so these companies still have some cyclical opportunities. The outlook is that everyone foresees a future dominated by fiber optics, though it won't happen that fast. That timeline is likely still several years away. But for now, as long as this expectation exists, it'll put pressure on the stock's valuation. Next, let's finish with copper and look at optical. As we just said, these two, ACC and AEC, are just current compromise solutions. Eventually, we'll have to use optical, since CPO still faces some challenges, so currently, in terms of data center adoption, they're still keeping some solutions, keeping some hybrid options or compromises. Now, this LPO has no DSP at all. It can save a lot of power, but it requires a very deep level of system integration. If there's any mismatch in the system, the bit error rate could increase significantly across the board. Then it won't achieve high-speed transmission. Currently, few people are adopting LPO because its deployment feasibility is relatively low. People originally thought, oh, can we just remove the DSP entirely? Right now, it looks like we can't. So the compromise is to have a receiver and a transmitter. And right now, we keep the DSP on the transmit side. Then on the receive side, we can temporarily remove the DSP process, so I can reduce power consumption and increase speed. Currently, this thing is convenient, relatively stable, and predictable. So right now, LRO is the mainstream for the 800 to 1.6T transition, but later on it should move toward LPO. So that's the current situation. Copper is still in use, but it'll likely be phased out. And CPO is still in development. Its adoption will likely take a few more years. LPO has some deployment challenges, so people are still using LRO. LRO is currently the top choice for mainstream data centers, so moving forward, we need to see Marvel's low orbit approach. What kind of connectivity are they using? And what's their take on different connections? How soon do they think CPO will be deployed on a larger scale or more effectively? Solving current transmission issues is a great entry point and highlight for us. All right, next, let's look at some asset prices. We can see the US dollar index is gradually climbing, but it's likely to face some resistance at this level. Currently, the US dollar is clearly a safe haven asset. Right now, no one knows when this conflict will end, as the situation remains quite murky and uncertain. There isn't a clear timeline for its conclusion, or any specific market expectations, so it's hard to say what will happen next. Consequently, bond yields due to concerns about a resurgence of inflation, and also this decline in the attractiveness of US Treasuries have continued to stay at relatively high levels. We can see that bond yields will likely remain elevated. This applies to the 2-year and 10-year yields, which rebounded sharply from their lows at the start of the war. Besides long-term yields, short-term ones might be pricing in the possibility of no rate cuts. Long-term yields more accurately reflect concerns about the economic outlook, which means there's more of this, the Anthony's rate. Now, we can see the market is in a rather paradoxical state. The indices are gradually trending downward, so the overall outlook seems quite pessimistic. However, if you look at individual stocks, some still show potential. We're seeing a bit of a divergence. So we believe that while some stocks might perform well in the short term, if the indices don't change their downward trend, these opportunities will be short-lived. Therefore, everyone should keep their trading cycles and frequency much shorter for now. Because currently, the indices are all showing a relatively unfavorable situation. Whether it's the S&P 500, the Dow, or the Nasdaq, it's the same story. The Philly Semi is similar. Other indices like the Russell 2000 and the equal-weighted S&P are also very weak. Looking at the indices, the downward trend remains unchanged. During this process, certain events or exhibitions might create opportunities for specific stocks. However, until the geopolitical tensions or the oil price deadlock are resolved, or at least until we see an end in sight, everyone must maintain a relatively cautious mindset and be even more mindful of the risks in your operations. All right, let's move on to the geopolitical situation. Geopolitics, well, the US-Iran conflict has been going on for quite a while now. Recently, it seems the US probably can't sustain this much longer, so there's a potential turning point. The turning point is that the US might not be able to withdraw, but the issue now is how they'll exit, as it's currently quite difficult for them to find a graceful way out. And today, we've seen Trump making statements saying that if China doesn't help out, he'll cancel the Trump-Xi summit. But despite what he says, the summit will likely still happen. Before many previous summits, Trump threatened to cancel, but he never actually followed through. So, as of right now, moving forward, there should be some negotiations regarding individual stocks. We might see this in the news, and later on, we may gradually see a temporary easing of tensions. As for the specific timeline, it's hard to say, because at the moment, there isn't really a reliable or clear basis for judgment. Now, the latest news is Trump mentioned over the weekend that Iran wants a ceasefire in negotiations, but Iran denied it, and neighboring Gulf states like the UAE and Saudi Arabia say they're still under attack. Although airports are gradually resuming flights, many are still being canceled. The UAE's main alternative export hub, the port of Fujairah, was also attacked. The Iranian foreign minister mentioned that they currently have no reason to talk with the U.S. because just as their leaders were gathering to initiate a dialogue, they were attacked by the U.S. and Israel. So they'll continue their self-defense activities. He also noted that while the U.S. could unilaterally end the war, as long as Iran can keep attacking the U.S., it can keep the U.S. and Israel bogged down in this quagmire. What they want is a guarantee of an end to the conflict, along with reparations and so on. So right now, what they're asking for is very difficult for the U.S. or Israel to provide. So everyone is currently at a bit of a stalemate. All right, so currently, other nations looking at this U.S.-Iran conflict find it all very confusing. They don't understand why things are being done this way, how it's reached this point, or what will happen next. Honestly, whether it's ordinary people or leaders of other countries, everyone's in the same boat. Well, right now, it really might depend on Trump, but no one knows what he'll do next. He's currently in a very unpredictable state. Recent news highlights this. During calls with G7 leaders, those other leaders repeatedly asked Trump, "What is your ultimate goal?" And Trump couldn't give a straight answer. And he only said he has some ideas and hopes the war ends soon, but he hasn't provided any clear direction. So for now, everything is still shrouded in a thick fog. Well, this is also the first time Trump has been unable to just act on a whim. Because currently, we can see that Trump's past approach has always been unpredictable, playing it by ear, and there's a huge element of spontaneity, a sort of "I'll do whatever comes to mind" vibe. Now, like with tariffs before, he could do that because he could single-handedly say he wanted to impose tariffs and then say he wouldn't. Or his strikes against certain countries, he could say he'll sanction them one minute and then lift them the next. But if you've already reached the stage of deploying troops and the war has already started, it's hard to say, "I'm fighting now, but I'll just stop later." This kind of thing actually, the decision is no longer in Trump's hands. So for now, as long as Iran continues its attacks, it can keep Trump bogged down in the Middle East. So that's the current situation. Overall, regarding this geopolitics, we're just keeping a close eye on where there might be a turning point. But given the current background, we don't see any sign of this yet. There's no clear indication of when the U.S. might find itself unable to continue fighting and then might be forced to leave. Right now, there's very little basis for an objective judgment, so we just have to keep following the news and see. Maybe Trump's words and actions, or those of the people around him, to figure out what happens next. Okay, next let's look at market trends. Actually, many investment bank analysts are quite optimistic about the market, but we should all maintain a relatively high level of alertness, because right now it's hard to say for sure, and there's a lot of uncertainty ahead. First, Goldman Sachs mentioned that the AI investment boom might offset the drag of weak economic activity on corporate profits, and they're maintaining their year-end S&P 500 target of 7,600. So they're still very optimistic, and they believe that this conflict the basic assumption is it'll end quickly, hence the 7,600 target. They expect S&P 500 EPS to grow by double digits this year and next, with increases of 12 and 10% respectively. However, they also noted that if the conflict escalates, it could still hinder AI investment. But they believe that an escalation in the Middle East, combined with severe credit tightening and a major slump in operations for big cloud service providers, would be needed to really impact the S&P 500. Simply put, they likely see this as a very low probability scenario. Their assumption is that in a mild case, the S&P 500 would drop to 6,300, which is actually quite a scary level. In a severe impact scenario, the S&P 500 could slide to 5,400. So overall, and Goldman's baseline assumption, they haven't priced in a recession or a major market downturn. They only say the market would drop if many extreme possibilities occurred simultaneously with a severe impact. So basically, it's still a relatively optimistic expectation and assumption. Next, let's look at Wilson from Morgan Stanley. He mentioned that the current adjustment in U.S. stocks might be nearing its end, as he believes the past 2 weeks were the worst since April of last year. So, currently, he mentioned that many stocks have already started a significant pullback, and this pullback actually began before the war, so it wasn't due to the war itself. Given these points, he thinks this correction might be coming to an end, but he also noted that he mentioned that while surging oil prices set a high bar for business and earnings, a brief spike shouldn't have a major impact on business or corporate profits. He still maintains a constructive outlook on the market for the next 6 months to a year. However, he did mention that if oil prices rise faster and the straits don't see an increase in traffic, there's a slight downside risk in the short term. So we can see that this Morgan Stanley analyst also believes that currently, he judges that this is the point where the U.S. stock market's consolidation or correction is likely nearing its end. Oil prices are quite high, and the situation with high oil prices might persist for a while, but it's unlikely to significantly impact corporate profits or future business performance. And if it's only oil prices that continue to rise, and only if the straits remain closed would there be some impact on the market. So that's a relatively extreme scenario. Overall, this analyst's baseline assumption is that the market will perform well in the future. Next, looking at the JP Morgan strategists, he mentioned that geopolitical tensions might not require tightening monetary policy. Therefore, he suggests that investors should buy on the dips. Buy-in. He believes that if oil prices continue to surge, it'll be a short-term event, and things will return to normal after a quick sell-off. So he suggests buying things like capital goods, semiconductors, and cyclical consumer goods, as well as some emerging market and Eurozone stocks. Currently, looking at these 3 major investment banks, their outlooks are all quite optimistic. You should use your own judgment on this because, as we mentioned before, the development of the war, oil prices, and the subsequent trends the uncertainty is relatively high. However, since we have the GDC conference this week, as well as the OFC, there will be opportunities for a certain degree of rebound in some individual stocks or sectors. At the same time, you can, in this context, look for targets that have been unfairly sold off while most stocks are declining. As for Foxconn, its performance is actually okay. Although some of its financial data didn't meet expectations, it mentioned that CSP capital expenditures are still growing and its server business will continue to grow. This also helps confirm that currently this AI development trend hasn't changed. Next up is Nebulous. So, what about Nebulous? There's some big pre-market news today. They've signed a 5-year deal with Meta starting next year. The total value could reach up to $27 billion. It'll use the Vera Rubin platform. That's why Nebula is up so much pre-market. You can see that major CSPs and tech giants are still working hard to grab computing power and pre-book this kind of capacity. Looking at NBI's, its stock price recently seems to have a good chance of breaking through this range and it's successfully consolidating at the upper end of the range. As for whether it can break through and go further, that's something everyone can keep an eye on. Another one is Lynas, an Australian rare earth company. This company already has very mature rare earth products and can sell them directly to other countries. It's currently the largest rare earth supplier in the Western world. Today's big news is they signed a binding letter of intent with the U.S. Department of Defense. Over the next 4 years, they will be supplying the U.S. with the neodymium magnets. The total value is $96 million. Also, the contract has a price floor of $110 per kilogram. So this is a huge positive for Linus. Actually, it's not just the U.S. Defense Department deal. Last week, they renewed an agreement with Japan to supply them through 2028, and that also has the same $110 price floor per kilogram. So you should keep an eye on this company. It's a very mature company, and it's listed in the U.S. under the ticker LYSDY. You can see its stock price has been doing quite well lately. If you look at MP, there haven't been many positives recently. It's just been consolidating. It's not moving much, so if you're looking to invest in rare earths or targets and critical minerals, you can still consider Linus Rare Earths. All right, moving forward, our main market focus remains on oil prices. Right now, you can see that oil prices seem to have dropped slightly again pre-market, but the overall trend is gradually moving back up. That is, after being knocked down from 120 that day, you can see the overall momentum is still very strong. It's possible it could challenge 120 again or even go higher. This will put some pressure on the market before that happens, so everyone should remain relatively more alert. That's also why we're introducing GTC and OFC today without recommending too many individual stocks, because right now, the hot stocks or related targets for GTC and OFC should be very easy for everyone to spot or connect to, so we won't specifically mention them here. Our main goal is to highlight the key points and observations from these events. Actually, if you're looking for a safer approach right now, you can wait until these details of the conference become clearer before building your positions in stages. It's not too late. That's the current situation. Overall, oil prices are still in an upward trend. So while oil prices are rising, we should maintain a relatively more cautious trading stance. All right, let's take a look at the pre-market gainers and losers. Okay, in the pre-market, we can see quite a few small cap stocks showing some potential. Also, we can look at a specific group, which is Bitcoin-related stocks, because Bitcoin has been strong lately. This is mainly due to perhaps hedging against war. Also, since Bitcoin is a highly mobile asset, it can exist outside of national borders, so it has a certain safe haven function. It might also be partly due to a rebound after a significant drop, especially for Bitcoin. Currently, its related stocks are showing some movement. But looking at these performances, like BMR, this company has shown some activity over the past few days, but it dropped back by the close. So it's possible that this momentum or bullish strength can't sustain it until the close. It might be relatively strong at the open or pre-market, but then it falls back by the close, repeatedly testing these levels. Okay, so that's the current situation. We can see that the overall market sentiment is okay right now. Let's look at the gainers. The main one, the more important one, is Nebis. As for the losers, it looks okay for now. Let's check the S&P 500. Now we can see that many well-known big tech stocks are up in the pre-market, including several of the Magnificent Seven. Meta, besides signing an agreement with Nebis, also has news about layoffs. It seems layoffs are a pretty good catalyst for driving the stock price up. Currently, we see that the ones leading the losers list are stocks that were perhaps more defensive before, like CF or healthcare stocks and so on, or agricultural chemical stocks, which are relatively more defensive. So, for now, today's pre-market sentiment seems okay. Today, we'll focus on the content of Jensen Huang's speech. And moving forward, we'll keep a close eye on the developments and technical details from GTC and OFC to see if there are any noteworthy targets worth watching. We'll be following up on this with you all over the next few days. Now, looking ahead to this week through Thursday, we'll see if the FOMC can continue this slight market recovery, or if it will, once again, dampen market sentiment. That's something we need to stay alert for. All right, that's it for today's Kwani Good Night. Thank you all for watching.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.